Inflation is out of control again, and now the RBA is expected to raise rates in February. Hey guys, Scott here. Right now, the internet is flooded with the same message. Inflation has jumped, the RBA has no choice, and Aussie mortgage holders are about to get hit again. And you already know what happens next. The people sitting on the sidelines praying for a housing crash, they're celebrating because they are convinced one rate hike will be the moment the property market finally breaks in 2026. Now, I get why people think that. If you follow the simplest version of economics, you hear rates up and you assume prices down and you move on. But real-world economics is a little different than what most people expect, and inflation numbers are almost never as simple as the headlines make them sound. So in this video, I'm going to walk you through what the inflation data actually says, what pushed it higher, which parts were expected, which parts surprised the market, and how the jobs data flipped the mood, and what the market is now pricing for February. And then we are going to land on the only question most of you care about. What does this mean for property prices in 2026? And are rate hikes enough to crash the market? Also, quick one, I do these updates every single day. So if you want daily property and economy updates, hit subscribe, hit the bell, and then come straight back because the details in this story do matter. All right, let's get into it. Let's start with the number everyone is reacting to. Headline inflation rose to 3.8% over the year to December, up from 3.4% the month before. That is clearly above the RBA's 2 to 3% target range, so yes, the reaction makes sense. But the headline number is only part of the story. The more important number is underlying inflation, which strips out the biggest one-off moves and shows the trend underneath. This is called the trimmed mean, and it is what the RBA cares most about, and you should too. That number came in at about 3.3 to 3.4%, depending on the measure you look at. So inflation has not exploded, it has not gone out of control like it did during the peak, but it also has not settled back into the target range. That is a problem. Inflation is still sitting too high, and more importantly, it has stopped falling cleanly. That is why the RBA is uncomfortable. Now, the next question is crucial. What actually pushed inflation higher? A lot of people are trying to brush this off as Christmas spending and summer holidays. Yes, December always brings higher travel and leisure spending. That part is normal. But this inflation lift was not just about shopping and holidays. Two things did most of the damage. The first was housing costs, especially rents. Housing inflation has been one of the biggest contributors over the past year, and housing costs do not fall quickly once they rise. The second was electricity prices. Energy rebates have been rolling off in parts of the country, and when those rebates end, the real cost hits households and shows up in the CPI measure. That is why electricity prices jump so sharply. So when you strip it back, this was not a sudden burst of reckless spending. A big chunk of the pressure is coming from essentials that households simply cannot avoid, like housing and power, plus some seasonal effects. So the RBA is under pressure to show that it is paying attention and that it will not let inflation settle above target for too long. Now stack the next force on top, because this is what really changed the market mood. So the next force I'm going to talk about, when you stack this on top, this is actually what really changed the market mood. Unemployment dropped again to around 4.1%, and job growth surprised to the upside. Now, low unemployment is a good thing for households, but for the RBA, it becomes a problem when inflation is already above target. Low unemployment means people have steady income supports spending, and spending makes it harder for inflation to fall. Some people point out that a large share of recent job growth appears to be government-related hiring, not a booming private sector. That is a fair observation, but here is why it still matters. Whether jobs come from the public or the private sector, they still support incomes in the short term. They still reduce the urgency for households to cut back, and they still keep demand alive. So from the RBA's point of view, inflation is above target and unemployment is falling. That tells them the economy is not cooling fast enough. If I strip away the jargon and put this in plain English, it simply means this. People are trying to buy more stuff than the economy can comfortably supply right now. When demand stays ahead of supply, prices stay elevated. That is the core reason rate hike talk is back. Now that you understand the logic, let us talk about expectations. Markets have moved quickly, and a 0.25% rate hike in February is now widely expected. But here is the detail most people miss. This is not being priced as the start of a new hiking cycle. CBA, Westpac, and ANZ are all forecasting one rate hike only in 2026, taking the cash rate to around 3.85%. and then a long pause. NAB is an outlier. It is the only big bank forecasting 2 hikes, one in February and one in May. That split matters because it tells you how uncertain the outlook still is. The base case is not runaway inflation and endless hikes. The base case is a single insurance move followed by a wait-and-see approach. And there is one more important buffer here. Most variable rate borrowers are actually ahead on their repayments, which cushions them somewhat against a potential rate rise. That does not mean higher rates feel good, but it does mean far fewer households are immediately in trouble. So now let's get into the big question. If the RBA hikes in February, what does that actually do to property? If you are watching this thinking, one 0.25% hike means property prices crash, I need to slow you down because it is not that simple in Australia. Yes, interest rates matter, but they are only one force, and in Australia, they have not been the dominant force when supply is broken and demand is strong. This is exactly what we saw in 2022 and 2023. Rates rose hard and people were convinced property would collapse, but then something strange happened. Prices stabilized and started rising again, even while rates were still rising. This was because the supply and demand imbalance became the bigger force. We had too many buyers, not enough homes, not enough listings. So the idea that rates up always equals price down is only true when the other forces are quiet. Right now, those other forces are not quiet. Australia still has a housing shortage, listings are still tight in many markets, and population growth has been strong. That means demand pressure is still sitting under the market. And on top of that, a lot of households have already adjusted to higher rates. They have cut spending, they have reshaped budgets, and they have learned how to live in a higher rate world. So if rates rise by 0.25%, that might sting, but it does not automatically remove demand. What it usually does is change where demand goes. Now let me explain the split, because this is where people finally understand what happens next. When we say the upper end of the market, we are talking about the premium segment, which is typically homes around 1.5 million to 2 million and above. That premium segment is usually the most sensitive to rate moves because buyers need bigger loans and bigger loans become more expensive fast when rates rise. History is clear on this. The upper quartile tends to cool first when borrowing costs rise. So if there is a February hike, you can absolutely see the premium end slow first. That's what will happen. But the affordable end often behaves very differently. And this is the part that surprises people, and this data may in fact shock you. Now, the demand pool is deeper in the affordable segment, and the competition is broader. You have first-time buyers trying to get in, you have investors who focus on affordability and yield, and you have buyers who have been priced out of the inner ring and forced to look wider. And right now, first-time buyer policy settings add an extra psychological push. When people feel there is a limited window to use low deposit schemes, shared equity schemes, and different state concessions, it creates urgency. It becomes first come, first served in people's minds. So if you think a 0.25% hike automatically scares those buyers out of the market, that is unlikely because many of them would rather adjust to a slightly higher repayment than step back, watch prices keep rising, and lose their shot at the market. This is the psychology that matters. Buyers do not usually disappear after a small hike. They compromise. They change suburbs, they change property type, they buy smaller, they move from houses to units, they move from the inner ring to the outer ring, so demand does not vanish, it simply shifts. That is why you can see weaker momentum at the top end, while the affordable end stays hot and actually can grow, because that is where the property groups collide. Now add the final piece. If unemployment stays low, forced selling stays low. And even if unemployment ticks from 4.1 to 4.3%, that is still a robust labor market by global standards. It is nowhere near the kind of unemployment you see in places where housing markets truly crack. Crashes require distressed supply and distressed selling. They need a wave of forced listings. If most people are still working, most people will fight to hold their home, and that makes a broad crash much harder. So if the RBA hikes in February, the more realistic outcome is not that property collapses. The more realistic outcome is that confidence wobbles, activity may cool for a short period, and the premium end will slow first, and the market will keep moving just at a different speed and in different areas. And then everything comes down to what inflation does next. If inflation cools again, the RBA pauses and the market finds a footing. If inflation keeps lifting, we will start talking about another rate hike. Right now, we're looking at one rate hike There is the possibility of 2, but it shouldn't be more than 2 under any circumstance this year. So here's the real question. Is this inflation move the start of a new trend, or a hot patch driven by housing costs, energy rebates rolling off, and noisy data that settles later in 2026? Because that answer decides whether February is a one-off move or something bigger. And it also decides what happens to property. Now, if you want to stay ahead of this, hit like, subscribe, and hit the bell, and let me know what you think. Does a February hike change the property story for 2026, or does the market simply just keep moving? This is your daily property update, your 5 to 8 minute update on the property market and the economy. I'll see you guys at the next one.